What is happening, DeRosa Insiders community? It's Matt Faircloth. Welcome to the Cash Flow Digest. Like I said, my name is Matt, and my company is the DeRosa Group, and we're a real estate company dedicated to transforming lives through real estate. We find ways to make things better. We make money while we make things better, and we do a little bit of both. So that's what DeRosa Group's all about. If you guys want to hear more about us, just go to derosagroup.com. There are certainly times where using your small community bank or using a regular old bank, like to lend you money for your development projects or for your real estate project is a good thing to do, because the rates are going to be nice and friendly, because they're going to take, the time that they need to lend you on your deal. But there's also other lending options that we need to be open to as landlords and as developers and as property and, improvers of real estate. We need to know what else is available to us. And there's a vehicle that we're going to talk about today that maybe gets a bad name in the world, which we're probably going to clear up, but also is something that I think is certainly misunderstood. And I'm bringing in an industry expert today to talk to us about this lending vehicle that is necessary. My company's borrowed millions of dollars of this kind of product successfully in the world, and I know his company's generated maybe billions of it. And it's a necessary vehicle that is used to make things in one condition turn into something else. And that product is hard money. And we're going to go deep into hard money combos today with our guest, Kevin Amolsch. Kevin, how are you today, buddy?
Matt, thank you so much for having me on.
Yeah, man. Thank you. Welcome to the show today. I really appreciate you getting on here, because I think that there's a lot of myths in the world, so to speak, about hard money. The naysayers and the people that are haters on our industry tend to view hard money lenders as the Tony Sopranos of the world, I'll loan it to you, but you're going to pay me my VIG or whatever. Yes, of course it's more expensive than a bank, because conceptually there's a little bit more risk associated with hard money. Understandable. And any lender needs to be compensated for that risk. But it's also a value. Anytime I've ever borrowed hard money, it's because I was grateful that somebody was willing to believe in me and give a shot at my project. And not for nothing, hard money can close in 2-3 weeks, maybe even sooner if you really, really push hard. A bank, you're lucky to get a bank to the table in 60 days, 90 days, maybe, right? So yeah. Talk us through, if you don't mind, let's hop in with you introducing yourself to our audience, about your background, and tell us all about you real quick, and then we'll hop into a cool conversation about hard money.
I got started in real estate super young. I was just turning 21. I bought my first house.
Awesome.
Just got out of the army. I was doing house hacking before house hacking was house hacking. So I rented out my rooms. My roommates paid my mortgage for me. And then I moved out of that and kept it as a rental. So there I was, 23 years old with a rental property. And I learned very quickly that real estate is a fantastic way to build wealth. Everything that we all know, the cash flow, the appreciation, the tax benefits, and the amortization, your tenant paying off your mortgage for you. So I really focused in on it. And I just fell in love with the financing side of real estate. Financing real estate is the deal. It's the structure, how you negotiate it, how you make your offer. So I started lending money, and I was doing the traditional thing for a while, beat my head against the wall. And then I learned very quickly that I need more control over the business. So I started raising private capital. This was back in 2006. So I was doing that right up to the crash. And my partner and I split. She wants to teach real estate. I like to do real estate. So I decided to start a new company. So I started Pine Financial in 2008. It's a hard money lending company, like we're going to talk about today. Approaching $1 billion in origination, about 2,500 loans. We're mostly on the residential side, about 80% residential and 20% on the commercial side. So I would consider the multifamily that you're focused on more of a commercial product. But yeah, that's a little bit about me. So
that's great. That's good. It seems to be sometimes, Kevin, I feel like there's more money in talking about real estate than there is in actually doing it,
Gosh.
Yeah. No comment, right? I get it. This is an interesting conversation for those that are out there, because my wife and I have originated a few private loans. And this is not that I put a hard money loan banner in my front yard of my house or anything like that, but for people that I know in the industry, as you probably did, you probably knew these folks that you were talking to and said, hey, looks like you're in the fix and flip business. Well, do you need a bridge loan to make that fix and flip amazing or whatever it is? And just my tip to the audience here is, if you guys have an IRA or something like that, that's a good way to get started, make a great return on your money. And there are, of course, hard money funds, as I'm sure you guys have investors that are making a great return on your money with hard money fund. We're in that world as well ourselves at DeRosa. We have the DeRosa Income Fund. But it's a great way for investors to passively make money. But if you're active in the space of real estate, for goodness sake, if you used to work at one job and now you have another job somewhere else, you could take your self-directed IRA and start lending it out. Not for nothing, you can't touch it anyway. You can't put it into your deals, so why not lend it to the real estate investor down the street, right? That's a great place to start. I love that's how you got started in the business.
It's interesting you bring that up, and it's making me think of that movie Dumb Money. Have you seen that movie?
No, I want to check it out though. Tell me about it.
Oh gosh, yeah. So it's about the stock. It's an individual stock. GameStop was the stock.
Oh, yes. Okay. I saw this movie on Netflix. I don't know what it was called, but it's like what's that?
Yeah. So you did see it.
I didn't watch it. But I saw it. You know how in the Netflix reels, I want to invest the time in this. So it's worth watching. Give us the brief synopsis of the movie and why we should all watch.
Yeah, I don't even know why I'm bringing this up right now.
Let's do it.
You said reminded me of it. So this movie is about GameStop and
Yeah.
how that stock was manipulated on both sides. So you have institutional investors shorting the stock, which just basically means you're betting on this value to go down. And if you have a lot of money going into a short position, you could drive the value down. Well, then you had this one individual guy that had a following on YouTube giving financial advice. He's like a college kid, and he gets this following, and they start buying GameStop because they think that it's undervalued, right? So now you have some pressure pulling the stock up from a YouTube influencer. So then you have this battle between the institutional money and what they call the dumb money, which is like,
Yeah.
I guess you and I, people that are just investing in stocks. And it's just, it's amazing how that manipulated the value. And the reason I bring it up is because if you have that kind of influence in the stock market is clearly risky. I mean, people are investing in this thing and they
If
lost
dumb
almost
money
everything.
can come in and pull a dying company like GameStop up like that, not for nothing, look at
Oh
what
my God.
GameStop is. It's a retail brick and mortar shop to go buy video games that I can go buy online, right?
It's amazing, isn't it?
Yeah, it's Blockbuster of video games, right? It's a
Yeah,
company that did not keep up with the times and everything like that. So it by no means should it have spiked the way that it did, but because dumb money came in and pushed it up like that,
that's right.
yeah, to me,
That's exactly right. And then the institutional investors, whoever was invested in those funds that were shorting it, they lost their money, right?
sure,
So you might be investing in a fund professionally managed and still have influence on a value,
yeah.
wipe out your investment.
I've
So
got
it's very
myself in trouble
scary.
a few times by going out there and saying, "Hey guys, let me ask you a question. What's the stock market going to do tomorrow?" You know,
Yeah,
and I get it, I happen to be shooting the show on a Friday, right? So it's not going to do nothing tomorrow because it's closed. But on Monday morning, is it going to go up? Is it going to go down? I don't know. How about we step up to a roulette wheel and let it spin around? If it lands on red, then it's going to go up. If it lands on black, then it's going to then it's going to go down. And if
it's
it lands on
amazing.
green, then it's going to crash. Okay, but like at the end of the day, we really don't know. There's very little control, and that's what I've always preached is that in real estate, the industry that you and I've chosen, and maybe we're preaching to the choir. A lot of our audiences in real estate too. But at the end of the day, we have more. I get you can't control everything, right? But there's way more control in a real estate portfolio than you do over a stock portfolio.
Yeah, that was my point. So
Yeah.
investing in a fund like yours
Yep.
or investing in private money,
Yeah.
like we're talking about here, it's just so much less volatile,
Yeah.
right? So it is a good investment for a retirement account,
Yeah.
for example.
So let's start talking to this avatar, hopefully an actual listener, but a make-believe listener who's listening to the show right now that's got maybe a few deals done, some operating success. Funny enough, I got started in a house hack as well as you did way before the cool kids were calling it a house hack. In 2003 was my house hack in that. So maybe somebody's done a house hack deal or two, maybe done a flip or done one or two rental deals. This operator, this avatar we've got here is looking to grow, right? How does hard money play in with something like that? What is the way that either you and I could rewind ourselves and make ourselves a lot younger and Matt and Kevin go get started in real estate back in 2005, 6, like you and I both got in, or we're talking to a potential client or a student or a borrower of yours. How does somebody looking to scale bring hard money into their business successfully?
The way you described that candidate is exactly the right person that should be looking at
Yeah.
hard money. Now, I want to say this, Matt. Hard money is just a tool we put in the tool belt, right? It's an investor tool. You don't use a hammer to drive in a screw, right? You use a screwdriver.
That's
So
right.
there's different tools for different situations. So I know the hard money has a bad name or a bad rap, as you said in the intro there,
Yeah.
but it's because it's expensive, not because it's not a quality tool.
Right. And
So
there's also,
here's the
Kevin, there's also bad actors in the hard money space, man.
oh, for
And
sure.
I know this
Everything
in
has
you,
that.
right? You're in here to bridge and help people build their businesses, but there are sharks in the hard money business that all you listeners need to be careful of. There, you can either be in the hard money space, as Kevin is, I'm sure, to generate a good product, make a good return for himself, good for return for his investors, and cash flow that comes in through the monthly payments that y'all make. Now, the hard money sharks that I'm talking about are the people that are lending you money on your deal, hoping that you can't pay them back, and they're in the repo business, right?
Yeah,
That's like
loan to own
yeah,
business,
the loan
right?
to own, but that's like buying a car from Joey's used car shop who's hoping that they can take that car back and sell it again, right? That's
Yeah,
not
yeah,
that's not the hard money business you guys want to do business with. We can get maybe later into cautionary tales and how to
yeah,
help
sure.
listeners avoid folks like that. But let's go back to the avatar. So they're looking to grow and scale. What's their like how should they apply hard money into their operations? How does it play?
Well, as I said, it's a tool,
Yeah.
right? It's just a high leverage tool.
Mhm.
That would be how I would describe that. It's not necessarily for people with bad credit or realtors or business owners that write everything off and show no income, although it does work in both of those
Yeah.
situations also. It's really it's for it can be for anybody, even good quality bankable
Yeah.
borrowers, right? And the reason for that is because of the leverage. So you go to a bank and they're going to qualify the loan based on a loan to cost and a loan to value. So the difference is loan to cost. So what's the purchase price? Maybe what's the purchase price plus any construction or rehab, and they're going to do 65, 70% of that number, right? And then they're going to take a value and they're going to limit the loan to value on that number as well. So they look at both. Now, a hard money lender doesn't have a loan to cost ratio. Well, not some of them. Every hard money lender is different. Okay, I should say that. A lot of hard money lenders don't necessarily have a loan to cost ratio. It's only a loan to value, and the value is an ARV, or after repaired value.
Mhm.
In the commercial space, it would be a stabilized value
Yeah.
or a repositioned value.
Mhm.
Whatever the completed value is, that's what we're looking at.
Yeah.
And so that allows for much higher loan to cost. In fact, in some cases, you could do 100% loan to cost, which would be your purchase and your construction on it, like a fix and flip or a BRRRR strategy, something like that. So that's the true
And
power of hard
guys,
money.
I want to just highlight, Kevin is not out here promising he does no money down loans, that all you got to do is show up to closing with a smile and a pen. Okay. I'm sure that's possible, and I'm sure it's been done, but all you'll be thinking that's all Kevin does, right? Sometimes you might have to go get a check and bring a check to closing too. And that is a possibility. I want to underscore one other thing that we talked about here, Kevin. In the stabilized rental world, up until recently, and I know you've been around as long as I have as well, up until recently, people didn't think too much, because rates have been low for so long, about the debt service coverage ratio, DSCR, when you borrow money. A traditional brick and mortar lender was willing to lend to you pretty much based on appraisal. Like, it's all okay, it appraises for $1 million. I'm going to lend you 75% LTV, off to the races. Let's go, right? Now, what's happening is the traditional brick and mortar banks have always had debt service coverage ratio in their equations. It just hasn't been the limiting factor. It is now, and that's because rates have gone way, 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 way up, right? And so what that means is that if you're doing a deal, the bank is going to limit how much they can lend to you based on your ability to service the debt based on today's interest rates. You did not hear Kevin bring that up as to the loans that his company will do, because they're not considering it that way. They're not looking to hold the asset long term. Anybody looking to hold the asset long term cares about DSCR. Another way to call hard money, maybe a nicer way to call it, is bridge debt, right? Because what is a bridge? It's a bridge. It takes you from here to here. And that's what hard money is. It's supposed to take you from dilapidated, rundown condition over here to rehab condition, right? And so the hard money loans, really, their primary driving factor is, what are you creating? Right? If you take a totally beat down property and you're going to be putting a certain amount of dollars into it, it's going to be worth a lot more when you're done. What's beautiful about hard money and bridge debt in general is they look at what you're building. What's the possibility of your creation here? We'll lend to you based on that. That's a fair win-win arrangement for you as a borrower, because you're getting consideration for the value, not the cost, but the value of what you're putting in. I mean,
Right. That's what makes it so powerful.
What's that?
And that's what makes it so powerful, Matt, right? Mm-hmm. And you bring up DSCR, which we should probably talk about that, because there's a significant storm coming because of that. But outside of that, in the residential space, it's DTI. It's basically the same thing, but they call it a DTI on the residential side. And it's just debt to income. So that's a ratio that lenders look at, and can your income support the debt? Now, hard money, we don't have debt to income ratios or DSCR ratios.
Yeah.
We only look at that stuff if you tell us, hey, my exit strategy is to refinance with the bank once this is bankrupt. Yeah. Once it's got tenants in it, once it's producing income, I'm going to go to the bank. Okay, well, now I care about those, because that's my exit strategy.
Yeah.
That's how
you got to make sure you get a loan on the back end, right?
Yeah, exactly. We just want to keep you safe, right? Now, if you tell me I'm going to fix and flip, well, I don't really care about your income supporting the debt or income from the property, because the resale of the property is what's going to support the debt. So that's what we're focused on.
So a few questions from the audience here. I want to pause here with you, Kevin, jump into what is the difference between a bank versus hard money from a point of an institution, right? So if you're the institutional lender, the originator, right? Can you go through real quick, and just in your own words, what the difference between a sticks and bricks bank that we just talked about and a hard money? And I'm from the point of an institution, I'm not 100% sure what they mean there. So in whatever ways you want to interpret that.
Okay, so a bank, brick and mortar, they're highly regulated, right? Credit unions are as well. But so you have a lot of regulation, but you have almost unlimited resources. So they could literally leverage like almost 10 times their deposit. So if you deposit $1 into a bank, they could loan out 10, something like that. So it's super, super high leverage at low interest rates, right? It's the overnight rate, the rate that the Fed is adjusting that we keep hearing about. That's the rate that the banks borrow at, and then they loan it out to you and me in car loans and credit cards.
Yeah.
So it's, with all of that regulation, it makes it difficult for them to lend money sometimes, especially right now. New York, the New York Community Bank, all the trouble that they're having after Silicon Valley went down last year. So now there's fear in banking. So they're getting really, really tight on their underwriting, because they want to stay compliant and they want to make sure that they have enough liquidity to return deposits if depositors ask for the money back. Now, hard money is completely different. In many states, there's no regulation at all. So there's like zero licensing. There's no oversight. It's really private people like me and you, Matt. It's like people like us making loans to other people like us, right? It's just individuals doing business with individuals. Now, it has institutionalized a little bit, and there is institutional capital coming into the space in the way of lines of credit and note purchases and that kind of thing, creating some liquidity. But for the most part, there's no set guidelines. There's no set regulations. You could be very, very flexible. And it does cost a little bit more, because I got to pay my investors more than a bank pays another bank, right? So it's just a little bit more expensive.
Yeah. So, and I want to just underscore one thing, right? Be like, well, why? Why doesn't a traditional hard money lender have to abide by the same rules that a bank does? Here's why I understand it to be, right? The government care is really there in a lot of ways to protect people, individuals, right?
Right.
Yeah. They don't do as much. They kind of let companies be the wild, wild west, right? And as long as you're not out to fleece people yourself as a company, they're going to let a company do what a company wants to do. It might, and correct me if I'm wrong, Kevin, but your company, your LLC, your lending company typically will not lend to an individual. The borrower has to be an LLC, correct?
We don't have that requirement, although that is common in the space.
Yeah.
But we do make a borrower sign an affidavit that they're not going to move in, that it's a business purpose loan, it's not consumer purpose. That's what keeps us out of away from the regulation.
All the fun Dodd-Frank stuff and all that kind of jazz, right?
Yeah, exactly.
And that's what takes hard money lenders, and that's how they're allowed to do what they do. It's an interesting situation because us as real estate investors, what are we? Like as Kevin said, you better not be moving into this property. You guys are going to take this thing and make money, right? You're going to use the hard money and use it to do good and use it to improve the property, employ some folks to turn it around for you and get on down the road and make more money and build your wealth, right? You're not going to use it to benefit personally. And so that takes it out of a lot of the regulations the government's put in place around lenders post the 2007-8 crash that Kevin and I both lived through.
Exactly right.
More questions here. And I get, you don't need to comment directly on the interest rates or whatever it is, but book user here said, I'm doing a hard money deal for a fix and flip for the first time. You could say if 11 and a quarter, 11 and a half plus 2 is, I guess you got to know a lot more about the deal. Probably you got more questions, you got answers on that one, but can you first, and then you can comment on it if you like, what, he says, which I don't understand. Let's talk about that part first. What does points mean? And that, can you talk us through what the nomenclature that you're looking at here is and what people should expect?
Yeah, there's 3 ways that hard money lenders make money. There's points, there's fees, and then there's a spread. So a point is a percent of the loan amount in a lender fee. So if you're getting charged 2 points, which is actually very common in this space. So that's the pricing here that this person is describing is actually right in line with what you're going to see with hard money.
So this is industry average. They're not necessarily getting fleeced. I'm sure there's like, a range in deals. There's no law, by the way, that says that Kevin has to lend the money at a certain number, but that's validating to know, audience member, that's within the spectrum, right?
Yeah, no, it's a decent price. So it's right in there.
Yeah.
Points. So if it's, say you're borrowing $100,000 and it's 2 points, well, it's 2% of the 100,000, so it's a $2,000 fee.
Yeah, and that's typically due up
The
front
interest rate is-
at closing. You either got to bring a check for $2,000, and I've also seen it done that if the deal's got tons of equity in it and lots of upside, it's possible but not guaranteed for the hard money lender to maybe roll the points into the loan if the sizing works. Correct? It's not guaranteed they're going to roll those in. You might have to bring that to closing. Correct?
Yeah, exactly. And some lenders will do 100%, like you and I talked about earlier. If the loan to value is low enough, you can do that. Some will require maybe 10% down. So you might have a 10% down payment plus 10% of your construction, and they'll loan 90 and 90. That's pretty common. So, and then the last one here is fees. This is the one that lenders don't. This is a hidden thing, you guys. You don't hear it from your lender. They're not going to quote this to you until you see it on the disclosures, but there's going to be some type of administrative fee, underwriting, processing, something like that. So that's just layered in a little additional profit for the lender. Sometimes that's negotiable, so you should ask, but make sure you understand what other fees, flat fees or otherwise, that they're charging you.
Yeah, and it's important to ask up front because I've even seen, like, sometimes hard money lenders hire a lawyer to generate the loan docs that you as the borrower have to sign. And this is a fun fact I had to learn the hard way myself, is a lot of times the borrower has to have the privilege of paying that attorney. Right. And so you got to pay lender legal, right? Pay their legal fees for them. How great is that? So you need to understand and that's common, by the way. In most commercial loans, it is, and believe it's not just a hard money thing. It's common all across the board. In more commercial loans, you're almost always going to pay lender legal. If they hire a lawyer, you're paying for it. Yeah. So understand when you guys, this is just a quick tip here, guys, make sure you understand what the fee structures are going to look like. You don't want to have a closing day surprise to walk into closing and say, what, $5,000 for lender legal? You didn't tell me it was going to cost that, right? You didn't even mention, read the fine print, right? So make sure you understand what fee structures you're going to be talking to. You're going to be looking at.
Look at these too, Matt. You definitely want to look at draw fees or inspection fees. You definitely want to look at, here's another hidden one, minimum interest. Some hard money lenders will say, hey, you got to do a 4 months minimum interest. Well, if you're going to fix and flip and you can get in and out of a deal in 2 or 3, well, then that's a whole nother month of interest that you got to pay, which maybe you shouldn't have had to pay. So I would look at those as well.
Guys, it's sneaky fees, right? Minimum interest fees you might have to pay. A lot of times, as Kevin said, a hard money lender might commit to 100% of your project. And that might mean, let's just say for fun numbers, $100K to purchase the property. You're going to purchase the property for $100K. You're going to fix it up for another $100K. And you're going to sell, God bless you. You're going to sell it for $350K, right? You found a screaming hot deal, right? Awesome. Kevin looks at that and says, hey guys, that dog will hunt. I'm going to lend you all that. Now,
Yeah.
He's going to lend you all that, but you're not going to walk into closing and walk out with a check for 200 grand. What's likely going to happen is Kevin will maybe lend you all the money you need to acquire the property. But as I understand, Kevin, the borrower would then have to then go and do legs of the construction. Like they got to go, let's say they got to do all the gut work, all the demo, and then do some framing. Okay. Then Kevin sends in a third party inspector, say, yep, you did do demo. You did do framing. Okay. Here's your, I approve. Here's a construction draw, right? Right. So that's how that goes. And there is a fee. This isn't just likely, and maybe not Kevin coming out there in his car looking at it. He's probably sending somebody like a, like a guy in a pair of work boots and like a building inspector, like an engineer, right?
We have to get the full report. We have to have the pictures. We got to make sure that
those folks aren't free.
Because there's a problem. If you don't do the work, we give you the money, and my investor's at risk, right? So we got to protect our investors. So
there's a fee associated with that, right? So even though you might get 100% loan, guys, you need to be prepared to do the work and then get paid by the hard money lender. You might be able to work something out with your contractor. They're willing to hold it. If it's a big enough contractor, like two dudes in a truck might not be willing to hold their breath for a little bit, but a big enough construction company that you guys want to gravitate towards using is going to be okay saying, listen, it's going to take me 2 weeks for Kevin's company to wire me the money. Are you okay if I, pay lump sum on the back end? Maybe you can negotiate that, but that's on the business end of the transaction. Big question here. Thanks for all the info. One more question. You said everything is in residential, then hard money has to do with the sale price. Besides a realtor, which I have one, how can I really get close to what my sale number would be? Any tricks or formulas you've used along the way? Kev, what are your thoughts?
Yeah, so this is one of the hardest skills as a real estate investor, trying to nail that value. And here's a problem I've seen, and no, I'm not trying to offend anyone, but they don't teach this in real estate school. So your realtor may or may not know how to do this. What they teach you is a CMA or a market analysis, right? Current market analysis. And what that is basically, here's a bunch of properties that are in kind of the area that might be similar in size, and here's an average or a median value, and then you got to try to hope that that's like a hope and a wish. But what if your property's on a busy road? The CMA cannot see that, right? Zillow doesn't see that. So those are not good ways to value. You really have to understand how to pull the good comps. And you want 3, maybe 2, 3 solds. And I always like one active comp or one pending or under contract, so I get a good snapshot of what's happening right now. The solds are obviously much more transparent. You know exactly what they sold for. You know if there's any concessions included in the sale price. A lot of times the seller will say, hey, I'll give you 3% towards your closing costs if you buy the house, like a bribe, right? So it's a legal bribe to buy the house, but that it impacts the net value of the house, right? So we need to back out any concessions. And then you have to try to learn how to compare an apple to an apple. So if I have a 1,200 square foot house and my house is 1,000 feet, that's a 200 foot difference. That house should sell for more. It's bigger. Right? This is just a very simple example. But so what we want to do is take that comp and adjust down to make it equal to what we're trying to compare it to. So we got to get like a price per foot adjustment and bring that comp down. So it's not just what it sold for. Bathrooms, for example, garage stalls, for example. We have to adjust for all of these different things. So it's definitely a skill. Clearly, we don't have time to go.
No, but you covered a lot of that here. But there's a lot of data points there. Does most hard money lenders, do they get a full appraisal, or do they do got it? So just a bottom line.
Most appraisals, most will.
But a bottom line, I mean, in a lot of times, guys, that is the longest lead time item. I don't know why it takes appraisals so long, but it just does. I mean, it's going to take them, could be upwards of 2-3 weeks to get a as is appraisal and an as improved appraisal. So what that is this is what it's worth today. 100K, whatever it is. And when we get done with the business plan that you tell that appraiser you're going to do, and you've already told Kevin you're going to do that too, you've laid all that on the table, I'm going to do this and this and this, and it's going to here's the suggested comps that I have in the market. Maybe you're pulling that off of Zillow, and the appraiser is going to adjust those things to be what they really think the property is going to be worth. These are professionals. They get paid to do it. It's going to be part of your closing cost, but might even have to pay it up front before closing and that for that appraisal fee. So good stuff. So covered a lot today here. What other tips and tricks do you, but before let me take that question back. What's the biggest mistakes you've seen before we wrap up here? I love talking about mistakes. And the reason I want to talk about is not for us to laugh at other people's misfortunes. I want to do it for our listeners to hear of things that they should not be doing. There are ways that they can avoid these problems on deals that they do, right? So what are some mistakes that you've seen made in the application of hard money in a real estate business?
Yeah, so I have some great mistakes that I'm seeing people from my seat, but they're not specific to borrowing hard money. So let me try to answer your question specifically, and then okay. So one of the things a mistake that I see people make is no diligence on their hard money lender. So you mentioned that the loan to own strategy. I don't see that as much, but what I do see is a promise to loan construction dollars and then not have the money for the construction. So let's say you're going to borrow 120 grand to keep it real simple, and 20,000 of that loan is for the remodel on the house. Well, if the hard money lender doesn't physically move that money into an escrow account, then they could potentially loan that 20,000 out to somebody else. And then when you're ready for your money, it might not be ready for you. And so I've seen this over and
That's
over.
cold-blooded
And
because you're probably paying some sort of a fee or an interest on it while it's supposed to be sitting
that's
there in
right.
the escrow account, Yeah.
Yeah, so this is something I see far more often than the loan to own
Mhm.
strategy. And then gosh, you'll lose your contractor. Contractors will not wait around for you.
Mm-mm.
If you don't pay them at when they're expecting or whatever you guys negotiated up front, they're going to go off to the next job, and then they might slap a lien on your property.
Mhm.
So it's very important to know that you have the construction money. So that would be one of the biggest mistakes I see using hard money. Another one is if you go with a lender that doesn't require monthly payments. If you don't have that monthly pressure, sometimes sometimes the priorities are out of line.
Yeah, yeah, yeah.
Maybe finishing the property is not a priority for you, and then it drags on. And these are short term loans, guys. It's two things. It's expensive, so you don't want that 11.5% interest for any longer than you have to, right? And two, there's going to be a maturity. Maybe it's 6 months, maybe it's 9 months, maybe it's a year, but at some point that loan matures and you have to pay it back in full. So you don't want to be getting up against these deadlines because it can be very expensive to renew it or to modify those loans, extend them.
Yeah.
So that would be another one. Make sure that you stay highly focused and get in and out of your projects as quickly as
You
possible.
got to treat a hard money loan like a hot potato. I've seen folks, and I've had this happen too in my earlier years of business. And I talk about this a lot in my book, Raising Private Capital that I wrote for Bigger Pockets, that, and I did this and I've seen many other people do this. You negotiate an individual private loan with somebody like, well, listen, I don't need to pay you monthly payments. I don't want to pay you monthly payments. I'd rather just pay you on the back end. And if you still treat that fix and flip with diligence, then great. But I've also seen this happen on my projects and on other friends of mine's projects, that if you're not making that monthly payment, the pressure's off you in some ways, and you can end up allowing that fix and flip job to drag out a little bit longer. And you get to closing and you're like, I have to pay this lender how much? Well, yeah, you got to pay them 6 months worth of pent up interest that you haven't paid them at all. Now they get their pound of flesh, and you got to pay that before you get paid in that. So I've walked into closing on a fix and flip thinking I was going to make X, and it ended up being a fraction of X because of that pent up interest. And looking back on it in hindsight, I would have rather gone into it with a better business plan and a little more cash that I could have serviced that debt during the life cycle of the fix and flip. And when I go to closing, all those proceeds are mine versus having to do a catch up with the lender, so to speak. Right. So be careful of that. Cause like I said, that can be a closing day surprise. Another one of those. And I hate closing day surprises, guys. So you got to stay away from those.
Yeah. No, speaking of closing days surprises, one quick other mistake here, Matt.
Please.
You brought up Bigger Pockets. Bigger Pockets has the best directory for hard money lenders. So if you're looking for a hard money lender, I mean, I'm not saying they're all great. Okay, I'm not saying that,
Yeah.
but they do have the best, at least comprehensive list of them, so that you can make some calls. One thing you might want to consider is working with a direct lender. Make sure they're loaning out their money. They operate a fund. They have the control of the private capital, and not necessarily a broker. So nothing against brokers, but they don't have control of the decisions, and they don't know if the money's going to be available or not. So it's a little bit more risk, and they layer on fees, right? So
yeah,
it's not that hard to find direct lenders, especially with a company like Bigger Pockets.
I got to tell you guys, the biggest mistake you can make in dealing with a broker, and I've seen this on commercial transactions and whatnot, you always want to work with somebody who's in direct control. The closer to control they are of the dollars, the better. Because I've seen a lender go in and say, yeah, man, I got you 100% loan to value. I'm doing the whole thing. I'm going to finance the whole thing. I got it all. And they line the whole thing up as a broker. And then all of a sudden, the lender that they've arranged to buy that loan at closing, the table closing, whatever it may be, they've lined this whole thing up, and then that lender changes their mind. Right. And they can change their mind 3 days before closing after you've already paid for the appraisal and everything like that. And that broker's got to make that difficult phone call to you to say, hey, listen, man, I was just kidding about that whole thing that I was going to do. And then they got to go back and say, well, I can't get you that anymore, but I can get you this. And you got to bring 50 more K to closing. And oh, by the way, closing's still in 2 more days. And the seller's not going to give you an extension. So you either have to cough up 50K more, or you lose all your sunk costs, appraisal costs, and everything, and you lose that awesome deal you had. I've seen that happen, not to me, but I've seen it happen to friends of mine that were working with brokers. It's very important, as Kevin said, working with a lender that's in direct control of the dollars. So if they say yes, that you can take that yes literally to the bank, right? So, Kev, this has been an awesome conversation, man. I really am enjoying this. If people want to hear more about your company, your journey in whatever form or fashion, please tell us a little bit about your company and what people would expect, and why should people approach you to learn more about and doing business with you, and how do they do that?
Yeah, I'm not going to be able to help everybody. One thing that we didn't talk about with hard money is it's very local. Like, in order for me to protect my investors, I need to be able to have control of the asset. So I need to be able to do my inspections and have a network in case we do get a property back through a foreclosure. I need to be able to go in there and do the construction. So we're loaning in Colorado, Minnesota, Wisconsin, and we just started in DC. So none of those 4 are the markets you are in, Matt, but
those are big areas, though. So a lot of folks listening may be involved in those markets. Got it.
That's on the borrower side. Now, on the investor side, we bring in private capital from all over the country. So we have multiple mortgage funds. We're one of very few that have a public fund. So it's a Regulation A approved with the SEC, and the benefit to that is twice a year financial reporting, full audited financials like you would get with any type of public company. So it's maybe a little bit safer fund to invest in if it's a Reg A over a private, like a Reg D, which was what most funds operate under. So I guess that's the company.
Yeah.
Right? We bring in private capital and we loan it out. It's a very simple business concept. We're about 17 people. We have 260, a little over 260 loans under management, and 160 million we're managing right now. So
that's great. So now tell us give us the punchline. How do people hear more about all this stuff? Where do they go?
Yeah.
Where do they go
So
to hear more about investing or borrowing from you?
Yeah, pinefinancialgroup.com is the website. You can learn more about us. You pulled up your book. I did write this book,
Fund Your Flip.
This is all about hard money, and it's commercial and residential. But if you're looking for different ways to fund a fix and flip, and this goes into a lot of detail about how to correctly analyze a property if you're choosing hard money over other types of financing. So fundyourflip.com. Super affordable. It'll take you over to Amazon.
There you go.
So I guess those are the two ways.
Fund Your Flip, guys. Everybody go get a copy of that book from Amazon. And what the company name one more time?
Pine Financial Group.
Pinefinancialgroup.com. You guys can Google Pine Financial Group, PINE like the tree, pinefinancialgroup.com, and you guys can hear more about Kevin and his company. And Nabiku has been kind enough to drop all the links right there, including your LinkedIn, so people can check out your LinkedIn profile as well, Kevin. Guys, Kevin, it's been a great conversation. Looking forward to talking to you again in the future. Hard money lending, guys, it is a necessary vehicle. You guys need to understand it so you guys can take advantage of a great way to build businesses large and small. Kevin, thank you for joining us on the Cash Flow Digest.
Matt, I had a great time, man. Thanks for having me.
Thank you. Hey guys, Matt Faircloth here. Thank you for listening again to the Cash Flow Digest. I really appreciate you guys doing that. If you guys want to hear more about what DeRosa Group has to offer, go to DeRosa Group, DEROSA Group.com, DeRosaGroup.com online. You can hear about all the great things that we offer from an educational standpoint and passive investment standpoint on our website. See you there. And if you guys want to join our online community, DeRosa Insiders on Facebook, where you can watch this program get recorded every Friday at noon Eastern, and you can come on as even a guest or ask questions on the show. We hope to see you guys on our online community, DeRosa Insiders. See you there.